Welcome. Welcome to Tradespoon. My name is Vlad Karpel. I'm CEO and founder of Tradespoon. And today we're going to have our weekly strategy roundtable where we talk about current market conditions and answer any questions you might have about your subscription. If you are new to trading stock or options, so if this is the first time you see this disclosure slide, I encourage you to visit the link, optionscreening.com, so you can understand the risk and suitability associated with trading stock and options. I'm not a financial advisor. I'm not registered with FINRA nor SEC. I'm showing you what I do in my own account based on my own risk tolerance level for general education information purposes only. All right, let's take a look at the current market conditions and the pullback. Right, so I mean, everybody is asking about, how far this pullback can continue. Right, we are down 10% on SPY. I think we're down 15% on QQQ, 15%, close to 15%, and small caps we're down actually a little bit more than 20%, which by definition implies a bear market. Actually not, okay, 19 points, okay, so 20% down on small caps. So for now, spiders and QQQs are in correction territory, and small caps are kind of borderline on the bear market. And again, you have different definitions of correction and the bear market, but nonetheless, everybody agrees pretty meaningful pullback because of the uncertainty in the market due to tariffs, whether we will or will not have recession. The housing data is cooling, the employment data is cooling, so retail data is cooling, GDP is going down. So you can definitely see cooling in the economy. And the question is, will it tip the market into a recession, or will we have a stagflation where, inflation still runs at 3% with minimal growth? And as a result of that, and uncertainty and what's going to happen the first couple of weeks of April when the tariffs deadline comes in place, market is down 10% and trying to find the next move in the market. So let's look at, first, to answer that question, let's look at our model. So if you look at the stock forecast toolbox for the next 10 days, the model is actually turning positive. We haven't made new lows in the past couple weeks, right? Kind of trading on spiders between 550 and 570 level, right? We're pinned at 560. And the model is turning positive, basically saying that the short-term market is oversold, right? And potentially 550, 560 is your low. And we could bounce back as high as 580, right? You can see the breakdown happen right at this 580 line. This was 2025 low, January 2025, start of January 25. This was December low. So, and there are a lot of open contracts at 580. So 580 is your first overhead, not the first, but longer term overhead resistance. So model basically says that this wave A, we have 5 weeks. Well, we have 4 weeks lower lows and lower highs. This week we actually had a higher high and most likely higher low. So the question, do we bounce back to 580 or maybe even 590, 600 level, right? That's scenario number one. Or do we go lower, right? And if 550 doesn't hold, which is a 50% retracement from the last bull market to this bull market, the peak of 21, the peak of 23 is exactly at the 480 level. We're at 50% retracement. If the 550 level doesn't hold, it opens the door to 500, 480 for another 10% drop in spiders. So you have scenario. So there's 3 scenarios, right? I would say one scenario is a V-shaped recovery, right? If first couple weeks of April, Trump administration backs off the tariffs, we could have a V-shaped recovery, retracing to all-time highs and beyond, right? Especially as we're approaching next earnings cycle, right? Because if the companies are still generating cash and the tariffs have no effect on the company's current income or forward guidance, then we have a V-shaped recovery. If the uncertainty persists, or if we impose tariffs on Europe, on North, South America, China, Russia, then we could have basically this wave B. We talked about wave B rebound, maybe to 580, 590 level, and then we have drop, the retest, right? So that's scenario number 2, right? And scenario number 3, we just continue to sell off, right? We continue to sell off and reaching 480 level, right? So that's scenario number 3. So those are the 3 scenarios that are possible, right? Scenario 1, V-shaped recovery. Scenario 2, you have a wave B, maybe 50% retracement of all the losses, and then wave C, all right? And then wave 3, just continuation, another 5 to 10% drop. And one of the bear argument is that if you look at the longer term predictions, so the long-term predictions were updated on going into March, right? 1st of March. And model basically predicted that the long-term trend is already deteriorating and losing momentum, but still positive. On the 1st of April, the model will recalibrate, will rerun, and because it has a new data point, and most likely this vector is either going to be flat or actually negative. So the long-term trend is becoming overbought and potentially pointing that this bull cycle is either coming to an end or maybe another couple quarters or couple months of this rally, and then long-term trend is changing to a negative. So that's the bear argument, that even if we do have rebound, right, we're not going to have a V-shaped recovery, and we're going to have another wave down, and at least retest of 550, and if 550 doesn't hold, then retest of this 530, I would say 515, 530, right, somewhere in here, retest, not retest but break. So that's what the model thinks. And the bear argument in terms of positioning, if you look at the spider's positioning, right here, I'm looking at, what am I looking at? April. Let's take out March 20. We do have triple witching expiration, so the market is going to be volatile. But if you look at April and May, basically, if you look at one standard deviation, just supply and demand for options for April and May contracts, one standard deviation, we are trading in this level, 580, 590, right? And if we have negative news, then this 525, 540, right, in terms of gamma position. So this is probably one standard deviation, and then anything in between, right? So scenario 1, we have V-shaped recovery, and we can actually take out this overhead resistance. Notice there is no gamma, very little positioning right now because of March expiration. So any positive news, and if we take out the 560 level, we could quickly move to 580, right? That would be argument, the bullish argument on positive news. On the negative news, I mean, you have some support at 550 and 545 and 540. So there's some support, but obviously we could quickly get to 540 level as well, right? So that's one standard deviation to the upside. This is one standard deviation to the downside. Anything, and for now we're ping between 550 and 570, right? We would try to take out 570 level unsuccessfully, and today we're trying to take out 560 level for now unsuccessfully, and next level is 5. So we're trading between 550 and 570. Right, that's the level we're trading. We're flip of a coin. We could be at 570 by end of the day, or we could be at 550 by end of the day, right? Those, or next week. Those are possible scenarios. So, okay, so let's pause. So this is supply and demand. This is the stock forecast toolbox, our model, long-term and a short-term model. And if you overlay these two pieces of information, that's how I usually make a decision. Short-term market is oversold, assuming there's no new negative information, then I think 580. So that's my core scenario, right? That we get back to 580 short term. Obviously, best case scenario, we've retraced all the losses V-shape, and the worst case, we're back to 535. So those are the three scenarios. So scenario number one is best case. Scenario number two, retracement to 580 and then retest of 550. And then scenario three, 570 is that's as good as it gets, and we are moving to 520, 535 level. So this is a very important exercise. I encourage you to go through this exercise when you trade, short term or long term, to determine what your exposure to the market should be, right? It's all about position sizing, right? How much risk are you willing to take? So I would encourage you to kind of basically always go through these exercises, right? Because if you're bullish like I am, at least short term, if you're aggressive short term trader, maybe I would increase your exposure to longs. If you're medium term, long term trader, I would sell into the rallies, right? If we do get to 570 or 580, 585, these are the levels you can trim your long positions, right? And determining position size is extremely important. That's why you want to kind of figure out, like, what do you think is going to happen based on your opinion, determine how much money are you willing to risk. Okay, so how many of you say scenario number one, V-shaped recovery, right? Paul, Paul didn't say anything negative. He reiterated the economy is doing stable and long-term trend continues to go, lower for inflation, and economy is resilient. People are still employed. So V-shaped recovery, scenario number one. How many of you? Just type in one if you think one. Scenario number two, market is oversold. Can bounce to 580, maybe even 590, but then another retest of 550, right? So we're trading between 550 and 580. And scenario number three, today we're down. Well, we actually pinned to 560, and we're gonna drop to 535. Third choice, one. So third choice down, lower lows. Thank you, Ian. Martin, three. Anyone else? Burl, Chuck, Kevin. Well, I know what Kevin's gonna say. Pam, Vitus. Everybody's three. And that's good, right? Because if everybody is three or majority of the three, right, then usually the contrarian, and it's not just us, right? If I look at the smart, bull, bear market sentiment chart, right, it's at historical lows, right? If I look at, it's 36% if you select it. They used to show 5-year chart. Let's see. Okay. Over interactive chart. Let's see. Unlock max. But you can see it's negative 36%. We hadn't have 36%, for a very long time, right? This is 22 lows, so extremely bearish. So it's not just us. Majority of the people are extremely bearish, and it also could be viewed in percentage of stocks above 20-day moving average, right? MMTW. You can see we've reached, just like market sentiment, we reached historical lows, right? 2025 low, 2024 low, close to 23, even 22 lows, 2020 lows. So these are extreme levels where basically everybody's turning bearish, right? And when everybody turns bearish, this is, if you're a contrarian, you start thinking about, well, maybe everybody, this fear is overdone. So market sentiment, number of percentage of stock above 20-day, above 50-day, I think. 50-day moving average, not much different. extreme oversold levels, right? Close to 23 level, 24, 22 levels. So that's something to think about, right? That at least short-term market was oversold, and we'll see today's triple witch in expiration, right? So you could see more volatility, right? We were at 570 yesterday, right? Today we're at 560. So we'll see where we're gonna, how we're gonna finish today. For now, we're kind of pinned to this 560 level, not going lower. And VIX is at 20. Yes, but I'm going with scenario number 2. Pam, thank you. What period of time was on your, what would be support resistance on May expiration? STDs. On May expiration. So if you look at Gamma, let's do Gamma. So you can see May expiration, one standard deviation is around 540, right? So I think the support is 540, 530. I mean, obviously we're at 560, that's the largest position in Gamma. You do have 550, that's the recent low, that's the 50% retracement, right? If you look, I'm basically looking for longer term. If you look at the May, I look at the monthly chart, right? Long-term trend. So we probably broke this long-term trend, right? We broke through the long-term trend and we're at 50% retracement, right? So if the 550 doesn't hold, then it opens the door. Next level is around 530. So the next level would be, this is where we spend, first quarter of 24, right? First quarter of 24, small regional banks, people were concerned about them going down. So you have, again, right, you had this in 23, you had it in 24. So 530, 540 is where your support is, right? Some semi-large position. We'll see how after today's expiration, how it shapes up. But I would say 530, 540 your support based on the positioning going into a May expiration, right? These are May contracts. And these are the long-term support. Chuck, let me know if that makes sense. Ian, which is news very tax prevails. Okay. I don't know if news and I'm not sure if I understand the question, Ian, but I don't think news prevail. News definitely move market up and down. But if you notice the positioning, right? One of the reasons we're not breaking through the 560, or if I add March expiration, right? If I add March expiration, which is today, right? There are very large positioning at 550, and there's a lot of overhead resistance at 565, 570. This is one of the reasons, right? This is one of the reasons we weren't able to break through 570 level, right? 570, 580 level. Same thing on the downside. The reason we didn't break 550 and 560 because there are a lot of people buying puts at these levels. But a lot of these puts are expiring today, right? Both on index front, on futures, on options level, on equity level. So this expiration could cause, now the news are not shifting the market equilibrium, but starting next week, if you do have news and dealers reposition themselves, then you could have large swings to the upside or to the downside. There's still CDA in the marketable balance in cash. Cost dollar average into market with balance and cash. I mean, I do like cost dollar average, right? And especially if it's oversold, then it does make sense to call it cost dollar average and then keep your large cash position. And the trigger would be 550, right? If we break through the 550, I would be a lot more defensive, right? Maybe start thinking about raising cash. But as long as we're above 550 level, 545, right? 550, 545, this is that 50% retracement, right? This is going back to 2021. So as long as we're at that 50% retracement, you could say that the bull market, the long-term trend has turned negative. I would agree with that statement, but kind of the momentum is still behind the bulls as long as we're above 545. If we drop below 545, then the momentum is going to be behind the bears. And I wouldn't be surprised if we do have 15, 20% correction on spiders. Any questions? So how do we help at Tradespoon? So we have different tools, right? Different models that I already kind of demo. And I think they're very useful. One is the stock forecast toolbox, right? You can look at the 10-day trend. You can look at the 6 months trend, right? And kind of determine where the key support resistance level, right? 580 was a support going into March. That support got broken. So you clearly can see market is going to have a hard time breaking through 580, 585 level, right? You really need some kind of a new information in the market, right? Like Trump administration is going to back off the tariffs, right? Back down, kind of ease their rhetoric. Then you can break 585. Until then, I don't think we're going to break 585. We could revisit 585, but not break it. So that's important information. Also the trend, right? When model runs on April 1st and it turns negative, then you know long-term support resistance turning negative. I mean, we have seasonality charts, right? We are going into the earnings season, right? Usually end of March, April is bullish time of the year, right? Usually, right? Assuming no new information. So that's another reason you could say from seasonality point of view, it makes sense that we reach the bottom. And even though correlation right now is very low to what usually happens in the market, but this is very similar to what happened in 2020, right? During COVID. During COVID, I mean, we didn't drop 10%, we dropped 30%, but still we reached the bottom end of March, and then at least April and May was strong months. 2022, same thing. We reach at least first iteration of the sell-off end of March, bounced back for a few weeks, but then there was another leg down because we were in recession, right? And interest rates, Powell would insist that interest rates would continue going higher, right? Higher for longer. So same thing could happen here. If Trump comes out in April and says higher for longer for tariffs and imposes these tariffs, then you will have a second leg down. So seasonality tools, right? What else? Then the models, right? We have different models that analyze different period of time and provide signals, right? So active trader is the model for short-term trading. You can see today, it's either no bullish signals and just bearish, right? Today was no bearish, or you can see stocks like Duke Energy or Allstate are the stocks that it shows in uptrend. And you can see Duke Energy shows strong uptrend, Allstate is an uptrend. So it finds stocks that supposed to outperform the market. And you can short, if you want to do day trading, we give you entry points, right? 119.12, we're right at that point. So this is maybe you want to think about buying Allstate, right? Or Burl talk about dollar cost average, then you split your entry into two halves, right? But you're risking 1% short-term trading. If you want to hold it for a few days, few weeks, maybe 2%, right? 2% gain, 2% stop loss. But that's active trader. You have strategy A, strategy B, right? Based on market conditions, you can look at the previous close or predicted low. Model predicted 119.24 is predicted low. And if you're not comfortable trading stocks, you want some leverage, you can do same thing trading options. But entry and exit are the same level, right? Instead of buying at 119.25, you can buy 115 call or weekly calls if they're available, and spend $4.25. Right. So options you can do the same, but still you're looking for 1% stop loss, right? If it drops by $1.10, you're out. So that's how you would trade these short-term signals, whether it's active trader, or weekly trader, similar model, but longer period of time, maybe a couple weeks, right? It's a 10-day forecast. So you can hold it for a couple weeks, 3-4 weeks. So Bank of New York, right? On Monday, if you bought, what was Monday? Monday was 17th. Yeah, so if you bought it on 17th, you enter the position, then if it jumps to 81, 83, you would exit the position, right? So these are longer term trades, same thing, dollar cost average. Model agrees with Burl approach, keep cash. Don't risk more than 1% of your portfolio. So we basically say especially if you new, start with 4 position, 2.5% loss per position. And if you do dollar cost average, so approximately 1%. You have a $10,000 account, you risk $100. You know, for entry 1, you risk another $100 for entry 2, and then your exit, right? But you don't risk more than 2.5% of your overall portfolio per position. And position size is very important, right? It's not number of shares, it's not number of contracts, it's how much money are you willing to risk to, invest to support your trade idea. And same thing, General Electric and stuff. So that's weekly trader. Monthly trader, same thing, just longer term trades. This is, if you long-term trader, investor, you want to hold it for a couple of months, then that's how you would trade, like American Express. So these are the models, right? Active trader model runs every day. Weekly trader model runs every week and posts these predictions on Sunday. So that's the models that you can subscribe to. If you want to see what I'm trading, and Keith, we have Keith from Options Hotline that also going to be in a live trading room today at the closing bell. So you have a morning bell and a closing bell where you can participate in the live trading room, or you can watch the recording if you don't have time. And you can actually see our trades, right? So today I'm trying to close, or actually closed Micron, right? I sold credit put spread on Micron. So I'm closing credit put spread on Micron. It had earnings. So I'm doing earnings strategies using options. I'm trying to close the hedge or trim my hedge position. So we do go through both bullish and bearish positions. So this is an example where I'm trying to close 550, 540 put spread, right? If it reaches $3.50, I want to close, trim my hedges. Sometimes I trade stocks. So this is, I bought stock at 194, trying to close at 209. So it's a combination of both stock and option trades. You can enter your phone number and get an SMS message every time I trade. And you can see all of my orders, all of my positions real time, right? This is all synchronized with broker-dealer account. These are not trades in Excel spreadsheet or hypothetical trades. These are actual trades that happen on exchange. And you have real-time communication where you can actually see what the trades are. Any questions about Elite Circle? So this is something I encourage you to try it out. 30 days money back guarantee. If you're not interested in options, you only want stocks, we have Robo Investor. This is stock only portfolio. If you, let's say, not interested in options or stocks, you want spreads, we have spread or premium portfolio. This is where I only trade, option spread strategies. So another, place where you can participate in the portfolio. So if you're looking for guidance and you want live trading room, and don't trade alone, it's always better to be part of a community. We have a lot of experienced traders, money managers in our live trading room, so it's a very valuable information where you can ask questions, bounce ideas, see what other people are trading. So that's live trading room. You can see what we're trading. So that's access. If you have your own trading plan, you have your own strategy, you're just looking for AI signals generated by different models, then it's active trader, weekly trader, monthly trader. We do have latest advances in neural networks. We train our model. We have a strong inference engine, and actually models pick the best models, which is interesting to use for different stocks, right? If before traders would have to decide, or quants have to decide which models are best suited for which stocks, now AI can make that decision. So that's pretty exciting stuff as well. Any questions about models or portfolios, live trading room? We do have a lot of free content. So if you want to learn, right, how to trade, we do have a learning center. You can learn technical analysis. You can learn about options basics, advanced technical analysis, portfolio management, trade management, trading plan, advanced options. So all of these topics, there are lessons, videos I encourage you to watch. We have workshops on different topics you can review. We have different guides, short-term trading plan, long-term trading plan, if you don't have your own trading plan. If you serious about learning and you have time and you want to commit, if you have financial commitment and time commitment, we do have one-on-one coaching program, which I also encourage you to consider, where you have a coach who's traders that can create a custom plan just for you, right? Everybody is different in terms of risk tolerance level, in terms of experience. They can coach you and help you achieve your goals. So we do have one-on-one coaching program as well. Any other questions? All right, what else? Let's go back to, so in live trading, we talk about idea of this, the economy of control. Two things I always say: trade what you see, not what you think. It doesn't matter what you think about tariffs, right? What matters is majority of the people, right? Game theory, what majority of the people think. But if you see support, resistance levels or trends, just trade with those trends, irrelevant to what your opinion is, and concentrate on things that are within your control, right? The economy of control basically says, concentrate on what's within your control. Within your control is how much, risk management, how much cash you have, and what's your position size, right? Number of positions. You can determine that from positive and negative visualizations and fight or flight response to avoid flight or fight response, right? Because if your position is too high, then it's going to be hard to determine. What else? Portfolio allocation, 30% of your portfolio in cash. Portfolio drawdown. Some of the items for trading plan, wait for 2 to 3 days to confirm trend change, right? If we're not making new lows for 2 to 3 days, or if we're making new highs, then maybe you have a reversal of the trend. 1 day usually doesn't change the trend. For positions, 2.5%. Allow more time, right? Right now, I would concentrate maybe on May contracts if you're bullish. Allow more space. If you usually look at 50-day moving average, now obviously you can see in these sell-offs, 200-day moving average is much better stop level, especially if you're a longer term trader. What else? And some of the trading on emotions. Do not chase the trade, avoid revenge trading. Don't trade because you're angry or lonely or because you're down. Try not to call the bottom, right? Look for signs of bottoming process, right? Like VIX jumped to 30, right, and back down to 20. I mean, these are usually signs of capitulation. I mean, obviously 40 and 50 would be a much better sign, but we'll take 30. But those could be signs of the or large spikes in volume, right? Large spikes in volume could be also signs of bottoming process. Any other questions? What does your credit spreads trade come out any certain days? Sunday. So premium service, premium spreads always comes out on Sunday. But then I trade around them in elite circle, right? So we usually get into position on Monday. Sometimes I add to position, sometimes I close it. That you will see in the live trading. But the signals comes out every Sunday, and there's a video, right? If you go to premium portfolio, you can see the video. This was Morgan Stanley spread from last week. You can actually see the video while I'm getting into the trade, but it always happens on Sunday. Any other questions? All right, if there are no other questions, then Keith will be here back at the closing bell. I'll be back on Monday morning, and thank you very much. Enjoy your time with your friends and family. Happy weekend. Get recharged, and I think next week is also going to be a pretty volatile day. Is your puts? In case of Morgan Stanley, this is a call spread. I mean, you could do a credit put spread, but this is a debit call spread, right? You can see VIX is collapsing from 30 to 20. You have to be careful, at this point, volatility is lower. Maybe call spread is better if you think that volatility is going to increase. All right. Pam, thank you. Chuck, thank you. Burl, thank you for participating. Thank you for questions. Burl, Chuck, Ed, Ian, Kevin, Martin, Pam, Fred, Vitus, Y, Michael, Steve. Thank you very much and have a great day.
No, this is regarding response. Yeah. That's a separate. Why not? I'm saying that's a separate issue. Yeah, that's. Trying to inject his opinion on the fact that what market should be trading is in fact whereas it's traded for real sense, and it's performed very well over the past 3 months.
Oh, this was a great explanation. So that just determines stuff. Unless you guys have questions. I mean, we're going to change these formulas as we get more and more cases. But for now, it's that's what it is.
I don't know. I don't know, but I'm gonna tell them. This is big. Developed it, and I told them, I decide. And contacting you today, and the first day that he's gonna be in that, what day he's gonna be in, so we can have a meeting that all in my whole business. It's much to do about it.
I mean, again, this is going back to this historical. It's like, at least my experience is that you calculate buying power yourself based on the physical cash. Here, we decided not to do that and rely on Apex, because Apex has its own margin engine, they're doing their own margin calculations. That's how they determine margin exactly. We don't have those formulas for that engine. So we basically always going to be dependent, we can run in parallel, because we don't know what their mathematical formulas, what quotes they're using, bid, ask, class, so it's impossible. But my experience in most of the brokerages, is that you do yourself find arbitrage, but it doesn't matter, right? You basically don't have to sync up. And sometimes you have discrepancies between back office and you, and then you will deal with margin calls, but they're very few. Right now, we kind of decided to use kind of a hybrid approach. Intraday, we use our margin engine, but then end of day, start of day, we use Apex margin engine. So that will create certain margin calls, I'm sure, in the future, especially as we turn on retail. But again, I think 9 out of 10 times it's